Buying a new car, that's the dream, right? But the loan that comes with it, not so much. In the next few minutes, we are going to break down how a few really smart decisions can literally slash your car loan interest and save you lakhs of rupees. Let's dive in.
So let me ask you a tough question. Is it possible you're paying lakhs extra for your car without even knowing it? For so many of us, the answer is, unfortunately, yes. All those hidden interest costs can inflate the price of your car by a huge amount. But here's the good news. You have way more control over that final number than you probably think.
So, where do we even begin? Well, it's not at the dealership, and it's not with the car model. Nope. Your journey to saving a ton of money actually starts with a number. A 3-digit number that is basically your single greatest superpower when you're negotiating a loan, your credit score.
And here it is, 750. You've got to remember this. In the world of Indian credit, this is the magic number. A CIBIL score above 750 signals to banks that you're a really low-risk borrower. And suddenly, they're not just willing to give you a loan, they're actually competing against each other to give you their very best interest rates. Think of it like this. A high score is pure leverage. It's the difference between just getting a loan approved and getting one approved on your terms. And that means a lower rate and a whole lot of money saved over the life of the loan.
But how much difference does it really make? I mean, really. Take a look. Having a score above 750 can often get you an interest rate that's a full percentage point lower. Now, I know 1% might not sound like a lot, but let's see what that actually looks like in rupees.
And boom, here's the impact. On a pretty standard 8 lakh loan over 5 years, that 1% difference is definitely not small change. It translates to a direct saving of 25,000 rupees. That is money that stays right where it belongs, in your pocket.
And you know the best part? Building a fantastic score is completely free. It just takes 3 really simple habits. First, always pay your credit card bills on time. Second, whatever you do, don't close your oldest credit card. That long history is super valuable. And third, just make sure your current loan payments are never, ever missed. That's it.
All right, so once your credit score is looking great, you're ready to make 2 absolutely critical choices that are going to define how much you save. We're talking about your down payment and your loan tenure. Get these 2 things right, and the impact is just massive.
The idea here is actually really simple but so powerful. The more money you can pay up front, the less money you have to borrow. And a smaller loan principal means you'll be charged way less interest over the entire life of the loan. It's the most direct way to cut your costs.
Okay, let's look at an example with a 10 lakh car. So in scenario 1, you put down 20%, which is 2 lakhs. Your total interest paid comes out to 2.4 lakhs. Now, in scenario 2, you manage to stretch that to a 40% down payment. Check this out. Your interest bill drops all the way down to just 1.8 lakhs.
Just let that sink in for a second. By just paying more upfront, you've put 60,000 rupees back into your own bank account. That is a seriously powerful move.
Now for the second big choice, the tenure. You know, it's so tempting to go for a longer 7-year tenure because that monthly EMI looks so much lower. But look at the trade-off. A shorter 4-year tenure might have a higher EMI, but the total interest you pay absolutely plummets from 4 lakhs down to just 1.55 lakhs.
Just look at that number. Wow. Yes, your monthly payment is a bit higher, but the result is a staggering saving of over 2,45,000 rupees. If you can manage it, choosing a shorter 3 to 5 year tenure is genuinely one of the smartest money moves you can possibly make.
But what if you've already started your loan? Don't worry, you haven't missed the boat. The savings don't stop there. There are some really proactive strategies you can use while you're actually repaying the loan. Okay, this is a brilliant tactic. It's called a balance transfer. After about 12 to 18 months of making consistent payments, your reputation as a borrower gets even better. You can then go to other banks and basically ask them to take over your loan, but at a lower interest rate, potentially saving you another 1 to 1.5%.
Next up is prepayment. So whenever you get a bonus or maybe some extra income from somewhere, use it to pay off a chunk of your loan principal. The key thing here is to make sure you've picked a loan with 0 prepayment penalties, which thankfully most banks offer for car loans these days.
And the effect of this is so powerful. A single prepayment of just 50,000 rupees can cut your loan tenure by 6 to 8 months. Imagine using your annual bonus this way. You could be completely debt-free years sooner than you ever thought possible.
Okay, we have covered a lot of ground here.
So let's bring it all together into a final, winning formula that you can use for your next car purchase.
This is your game plan, your cheat sheet. It's just 5 simple steps to huge savings. Maximize that down payment. Choose the shortest loan you can comfortably afford. Keep that credit score above 750. Shop around for a balanced transfer after a year, and prepay with any extra cash you get. That's the formula.
And why does all this matter? Because when you follow these steps, you're not just saving a little bit here and there. You can cut your total interest cost by 30 to 40%. This isn't just about optimizing a loan. It's about fundamentally changing how much you actually end up paying for your car.
So we'll leave you with this one thought. The knowledge is now yours. You have the strategy to save a huge amount of money on your next car. The only question is, what will you do with all those savings?